Okay, so talk to me about the market crash and how that will affect your super and your pension.
Okay, so we'll separate super, so the accumulation part of super versus the pension phase of super. So let's take a very young person like yourself in his early 20s. So someone who's got, they say, 30 or more years till retirement. So let's look at the math of what's involved here, right? So at the moment, you're a net contributor to super. So every quarter, when your very generous employer pays your very generous super contribution to your super fund on your behalf, as legislated, that goes into super fund. It essentially buys into whatever assets you've picked. And let's pretend you're 100% shares, right? So you're going directly into the market. So when that happens and you put, your, what do we pay, 40,000 a quarter or something as your super contribution,
right.
Something like that. So when that goes in, that buys units in something, right? So whatever the share price is, if the market's up at that point in time, you're going to buy a little bit less. And if the market's dropped, so at the moment, your super's buying into the market at 30 to 40% lower than it was a month ago.
Yep.
So if you think about that, the long-term profitability of the economy and the underlying shares or whatever, they are what they are. That's not really going to be material change. And we look at the long-term run of, overall profitability of the share market, it's basically the same as growth in the economy, right? So assuming that plays out okay, then you're going to get that trend. So you'd assume at the moment that it's a reasonable likelihood that we're below that trend, where the markets come. Now, are we just below it? Are we well below it? We can argue about that, but we're not above it, okay? Unless coronavirus is here to stay, we're not above it. So you're kind of buying in at a bit of a discount. So from that perspective, if you're an accumulator, you want the market to crash and stay there for 20 years because it just means the price is low and you're buying more units with every dollar that goes in. The last thing you want is the market charging ahead because you're just paying more for the units as you go in, right? So from your perspective, quite selfishly, you're like, crash, baby, crash. Let's get in there, stay down. Let me buy as many units as I can because I'm a net accumulator. Whereas if you're a seller of units, you want the reverse of that. You want a bubble. Right, you want prices to be really, really high and you want to be selling out of that. But again, even if you're a net seller of units, most sellers of units, they're not selling heaps of them, right? They're selling small portions at best. So then it depends. So let's move to the pension phase now, right? So I'd argue volatility and especially major volatility for accumulators is only a positive thing. All it does is give you more chance of buying below real intrinsic value.
Right.
Where if the market was just linearly charging up, then you'd be paying the right price the whole way up, but you'd never be getting a bargain.
Yes.
Okay, so crashes are a good thing to you and booms are bad because you're just paying more, right? The reverse of that is you're the retiree, right? So now you're at the point where you say, well, now I'm drawing on my super. And here's where a thing called sequencing risk is important. So sequencing risk basically says you might get an average return over a period of, let's say, 20 or 30 years, an average return of, say, 8%. But that doesn't come 8% one year and 8% the next and so on and so on and so on. You get that as an average return of plus 40 minus 25 in individual years. But the order in which those returns come matter. So if all your returns are great at the beginning and it blows your balance up and then the returns are bad at the end as you're running it down anyway, then it doesn't. That's a good thing to you. Whereas if the reverse is true, when you start with a big balance and all your returns are negative early on and you're drawing from those depressed balances disproportionately, right? Because when the price went up, for every bit you sold, you're selling a little bit less proportionally, whereas it goes down, you're selling a bit more proportionally. So sequencing is a big problem if you're selling units that are linked to the market price. If you're not, if it's coming from cash or if it's coming from distributions, the dividends or the rent or whatever from those assets, doesn't matter. Because the price of your CBA shares are just, let's say they're down by 30%, but the dividend's the same. And the dividend covers what you need to, what you're drawing, then you haven't sold any CBA shares, right? So the whole point of in your portfolio construction, the key aim here is that's what we really mean by how long you should be in investment. It's not a case of saying, okay, well, you should be in investment for, say, at least 5 to 7 years. Doesn't mean in 5 to 7 years you're going to sell it all and therefore you need the price to be high. It means you don't want to have to sell it within that time frame, because the chances of it not being a reasonable return in 5 to 7 years is reasonable. There's a reasonable chance at any period in the share market between, say, any 7-year period, there's a reasonable chance that your return could be zero, right? Even slightly negative. There's very rarely that you get a negative return over 7 years, but it's still possible.
Right.
It's happened from time to time. But 10 years is extremely rare. It's really only a couple. 10, 15 years, none. 20 years, none, sort of thing. So that's what they mean by the time. And when we say that return, the dividend return through that period of time is very solid. So if I look at the volatility in return from the capital, the pricing, that can vary. I think the record's something like plus 85% in a year and about minus 55. So huge swings in terms of the price movements. Right. And if I look at what we call the standard deviation, so the average amount of volatility, it's like about 13.5%. So in other words, if the average is sort of 10, minus 3.5 to sort of 23.5, that sort of 2 standard deviation range, about 68% of returns fit inside that. And if you go one more deviation, 95% of returns fit inside that, right? So that spread covers, so 95% of returns fit somewhere between, let's call it, minus 17% and plus 30 to 37, right? In any sort of 1 year period. But if I look at dividends, the standard deviation, the average dividend is about 4.2% long term. And then if you add franking credits, that adds another 1 to 1.2. So let's call it 5.2, 5.4% average cash flow from the Australian share market. The annual standard deviation of that is 1%. Right. So in a really, really bad year, you're getting 3%. In a really, really good year, you're getting 7% dividend. So it's extremely rare for dividends to be below 3 across the entire market. Now, depends on what you own. You own a bunch of exploring mining companies, dividends be 0. They don't pay dividend.
Right.
If you own purely banks, your dividends might be 10% at the moment in particular. So they might be really, really high. But on average, the market's, that sort of 4 to 5.5% range is where it sort of sits. And it really doesn't change, even through recessions and through periods of substantial economic downturns. So if you're relying on that cash flow and you've got that sort of, that cash dam that we talk about, that stable pool, then as a retiree, yes, your balance has dropped, but your cash flow and the cash flow capacity of that asset pool really hasn't changed a lot, right? As long as this economic shock isn't, a 5 and 10 year, the economy really has crunched by 30 or 40%. And I think that's never happened before. It's extremely unlikely that this event, if there's going to be that event, it's unlikely that this is it.